Welcome to FinTech. What is it? Too much potential, so little impact, or so much potential, too little impact. That's how we named it. And we usually love putting question marks at the end of these titles too. My name is Jackson Mueller. I am the Associate Director at the Milken Institute Center for Financial Markets based in Washington, D.C. I head our financial technology program there. Our financial technology program first launched back in October of 2014, really before FinTech made its way into DC. So we like to think of ourselves as one of the first think tanks to really focus on this ever-expanding space. So again, glad to have you here. We have a number of distinguished guests with me to talk about all things FinTech and what their platforms are up to. During this session, I do want to, there's two things I really want to focus on, and the first is on impact. I think a lot of these discussions when we talk about FinTech, we tend to think about its potential, tend to think about what it can possibly do, talk about the future of FinTech. Frankly, what I want to know is what's happening in FinTech now, and what's the impact that's happening at this point in time, rather than focusing on its potential. I think that conversation is already overdone at this point. The second thing I really want to focus on in particular is to focus on the viability of a platform. So as we talk about impact, whether it be inclusion, access to capital, transparency, as these platforms try and connect with more and more customers in various regions of the world, how are they making sure that they don't there's not undue risk at the end of all of this, and that they're not ultimately subjecting their platform to certain undue risks, for lack of a better word. I do want to frame the debate before we even start with questioning. One of the first studies that I read in this space came from a NYU professor, Thomas Philippin. And I don't know if any of you have read some of his stuff in the past, but what he found was that over 130 years in the US financial services system, the unit cost of financial intermediation has largely unchanged, and it's averaged 2% over the past 130 years. So as we talk about FinTech, as we talk about impact and access, what I really want to keep in the back of our heads, as well as for the attendees here, is to think about how is FinTech ultimately, this era of FinTech I should say, ultimately going to move the ball forward in terms of decreasing that unit cost of intermediation ultimately. And also I should say similar studies have found in various other countries the similar results. So it's not just the US that we're seeing this issue. Jonathan, let me start on the impact side of things. At our recent Asia Summit out in Singapore, you had mentioned that Ping An has roughly 400 million users that interact with your company on a daily basis or annual basis, what have you. I think from my perspective, that's great. I think it's great that you're connected to 400 million people, but what at the end of the day how are the end users ultimately benefiting from Ping An, and what are we seeing in terms of their abilities to access capital, and is it greater efficiencies, and are we finally seeing the kind of unit cost of intermediation decline thanks to your platform?
Well, thanks. Firstly, it's a pleasure to be here and to hopefully contribute to the discussion. Let me just make an opening reaction to the study you referenced from NYU, and it's a very serious academic study with many world-class economists that have been involved in credentialing it and working with the author. I read it though in a slightly different way. I read it as that 2% is kind of an equilibrium that the market has found to basically deliver financial as a cost to deliver financial services. Inside that number, you've got, the 7 basis points you get charged to invest in VTI if you invest in the total US market through Vanguard, and you've got private equity funds that might be charging 3% or 5% on an annual basis effectively, including carry, who may be doing a fabulous job and whose investors are delighted. So I think simply to say that number reflects the efficiency in itself is incorrect. I think it is fascinating that it's been constant over time, and I'd love to understand why that seems to have, why that number seems to be an equilibrium point that the market has solved for in the US for 130 years. So that would just be a point there. Having said that, I think that the traditional financial industry has been incredibly slow to adapt to contemporary technology that's now available. We'll talk about that later on. The China landscape is, I think, very interesting in this whole context. China has gone through a technology transformation in the last decade and possibly the last 6 years that's probably more pervasive and more fundamental within the consumer society than probably any other country on earth. Certainly anything approaching the scale we're talking about in China, to the point where cash has basically disappeared from daily usage in the society. You buy a newspaper, you pay a housemaid, you buy flowers in the street, you're paying it on a mobile platform. And you've got two companies that completely dominate the online payment landscape. But so many other aspects of people's lives have been transformed by the availability of services through technology. I think it's one place where we can genuinely see the beginnings of what technology and FinTech in particular can do in the delivery of financial services. At Ping An, you referenced our digital user base, which is about, I think our disclosed number is about 430 million as of the end of December last year. You know, we think of ourselves as much a digital company and a technology company as a traditional financial services company. And so you ask, well, in what tangible ways is technology supporting our business on the one hand and our customers on the other? Everywhere. I mean, we have in our traditional businesses, in our auto insurance, for example, if you ding your car, what you do is you scan the damage with your cell phone, and then we have an AI engine that has every model of every car encoded in it, and we can tell if the damage is structural or superficial. We then have a pricing engine, and then we give you an offer, and so we'll say, Jackson, that's great. This is going to cost $800 to fix. We can either credit you the cash right now, and you can deal with it yourself, or you can go through our claims process, up to you. So 30% of 12 million claimants choose that electronic transfer option. So I think what that's doing is putting the customer in control. It's delivering incredible transparency, speed and responsiveness, and it's using technology. In credit, I think we've seen an explosion of consumer credit in China through what are called P2P platforms. So they're basically non-bank funded online and offline delivery of loans. So we have one of the largest platforms of those. So we're using about 6,000 variables to assess credit. We're able to, we've got a $50 billion portfolio, and we have many ways of funding that through partner organizations, through retail clients and retail distribution that we have, some of our own funds that we commit to doing that. We have a loss rate inside of 3%. And we have, you know, Citibank and other international bank risk people running the whole program. So, you know, our accounting is extremely conservative. And we don't take any paper documents from anybody. We take the view that either a paper document is verifying something someone's already told us, or it's fraudulent. In either case, it adds zero value. And the challenge was to find electronic means of basically triangulating or verifying every single piece of information we've got. So, you know, I think you've got a fundamentally more efficient way of delivering credit. In a market, by the way, where universal credit bureaus still don't exist. There's a PBOC, bank bureau. It's pretty fragmented. It's very hard to get a complete view of credit exposure across the market. And this is against a background of there's, I think, it's 2,600 credit providers that are sort of rather rapidly now being, you know, consolidated and cleaned up by the regulators as the sort of innovation phase of that sector has passed. And it now needs to be run in a, you know, probably a structurally more sound fashion. So, I mean, I think there are a couple of examples. We have the largest digital wealth management platform in the world, Lufax. It's got 80 billion in assets under management. You know, we're enabling clients to invest in a very wide range of asset classes at extremely low cost with effectively no minimum. I think that there are many examples where we can point to where technology is fundamentally enabling our business. I'd say that for all institutions, there's still a path to go. Our company's 30 years old, we were probably freer from technology debt than institutions such as my former company, Citi, which was 200 years old. At Ping An, we don't have any mainframe computers. We've replaced all our core platforms in the last 2 to 5 years. We have our own cloud, so basically 80% of everything we do in the data processing area is virtualized and stateless. So that helps us a lot. But there's so much more we can do, and maybe in the later discussion we can get into some of that.
Just real quick, those processes that you've digitized, which almost seem like, from what you've said, everything across the platform almost, have the cost savings as a result from that? Have you been able to, has those savings trickled down to the end user at the end of the day in forms of better pricing for products, that sort of thing?
It depends on the business, but the answer is definitely yes. In some parts of the China landscape, you've got regulated pricing. So for example, we have a very large, what we call telematics program, where in auto, just as another example from that business, we use your cell phone, and we can tell from the cell phone, if you enroll in the program, where you're traveling, how fast you're going, whether you're obeying the speed limit, whether you're stopping too fast, etc. And we can create a driver score from that. It's called Good Driver, and both customers and non-customers can enroll in it. And if you are indeed a good driver, then we can reflect that in loyalty benefits, and we have some discretion, but not total discretion, to vary your pricing, as an example.
Sasha, let me turn to you. Just from the U.S. perspective, I threw a number of, I felt pretty confident in the numbers that I provided you during our panel prep call, which you shot down immediately. But the numbers that you provided me were pretty interesting. 56%, I believe, of the U.S. population, I think it's 130 million people, have subprime credit. Is that correct? So how is
according to FICO?
According to FICO, how is a platform like LendUp able to offer some positive, credit services that really help the end user at the end of the day in terms of, a better credit, better savings opportunities, more education on finances? How does LendUp provide that through technology?
Yeah. Well, first, thank you for letting me come here with a tie on. It's my normal attire is a t-shirt and jeans.
How long has it been since you last wore a tie?
I don't. My wife just bought this for my birthday, April 1st. That was my first tie. I think on the Hill with our government affairs person a couple years ago. All right, so let's go back to it. So we have to remember that the subprime credit market, this is in sort of the U.S. unsecured, it's about half of the country. It's $350 billion. It's a market that is screaming for attention and services, better financial products. When we think about credit risk that we take as a business, risk really falls under two main categories. There's sort of your ambient level risk, and then there's your volatility. So your ambient level risk is kind of how you can price your day-to-day sort of credit products, and it is high-risk lending. There's a high level of ambient risk. But when you're thinking about credit risk, the thing that is the most important is the volatility. Right? So it's how far does this differ from the means? And what we've seen when you look at the last 15 to 20 years of Federal Reserve data and the major credit bureau data, that actually unsecured subprime U.S. credit is the most stable asset class that we have in the unsecured market, which means it's the least amount of volatility. When we look through the last recession, it peaked at about 47% volatile from the mean, where if you look at prime and super prime, it can get up to 200%. So it's actually like a really good asset class to think about as you're sort of originating your products. When you then take that and you can supplement modern technology, you get two benefits to it. And this is where it sort of gets even more exciting. One, you can use more data to supplement traditional underwriting techniques to unlock and figure out who are the good credit risks and the bad credit risks to an even more or a higher degree of confidence. So what it does is it helps you identify and unlock access to capital to once you can underwrite them. The next big wave, unfortunately we're still a little bit further behind than China, is the mobile phone, which still doesn't quite have the same payments capabilities here as you guys do in other countries. But it now gives a direct access point to consumers. Consumers now have a choice about where to go. They don't just have to think about the real estate around their neighborhood or the real estate around their jobs. So when we take the average mainframe sort of systems of banks, which is about 38 years old in the United States, and then you start a financial services company from scratch, you can make the choice of using the same technology or build from the ground up. We decided to build from the ground up. So we can take access to the most stable asset class, using more data, using mobile phones to deliver that directly to the consumer. And then as a result, you end up with single-digit loss rates on originations compared to some of our brethren in the subprime card space that can go anywhere from 15 to 35% losses on originations. So we feel pretty good about the business we've been building over the last couple of years.
Sallie, let me turn to you, in addressing another particular gap, and that is the gender investing gap. What role does Ellevest play in this space, and how are you able to, try and address this gap through your technology at Ellevest?
I will in a second, but first I want to talk about something else you spoke about, which is the 200 basis points of cost for financial intermediation. So it's interesting, when I took over running Merrill some time ago, I remember going in and sort of digging through the numbers, and we always talked about, in all these businesses, pricing pressure, pricing pressure, pricing pressure. And when I actually looked at the ROA, revenue on assets, for Merrill Lynch, the wealth management business, it had been about 75 to 80 basis points for 15 years. And that's as far back as the numbers went, so remarkably stable. When you consider the price of the mutual funds or the other investments that individuals had, it gets you pretty close to your 200 basis points when you add some hidden fees and so on. How were we able to do that? One thing is there were mix shifts within the business, so it wasn't all just single stock trading, but the business mixed over to managed accounts and so on. So the industry sort of found its way to, they would argue, deliver more value, but to deliver a higher price. And the other reason is because so much of the pricing is hidden. So a few years ago, I'm a client of those companies. I'm no longer with them, but I thought, just for fun, I'm going to sit down with my financial advisor, who happens to be, as you might imagine, if not the best, they're the second or the third best. And just for fun, let's the two of us figure out how much I paid Merrill Lynch and you last year, just for fun. And we couldn't do it because there were hidden fees, because some of the fees were coming out of mutual funds. So instead of being labeled, well, first of all, when you looked at the statement, there was sort of interest and dividends, and other. What's other? Other are the fees. Okay, we call them other. And then you began to say other fees have come out of performance, which I would have had to know what the performance would have been minus the fee, et cetera. And eventually, then we started talking about what the spreads were on the bonds that you traded for me versus what it otherwise would have been. We completely gave up. And so a reason everybody in this room knows that the pricing has been able to remain stable is when you have hidden pricing. When it comes to money, no one knows what the performance should have been. That's what happens. Well, enter Ellevest, which is today a digital investing platform for women. We came out with a 50 basis point fee. It's the only way we make money. And of course, then the cost of the ETFs, very visible underlying. And when we did the testing, our consumer testing, the women came back and said, 50 basis points, my gosh, that's amazing. So fair, so good, we're so excited. And that lasted for about 15 minutes after we rolled it out, when they began to look at the other digital investment platforms that were out there and say, wait a second, if these guys are at 25 basis points and you're at 50, how do you justify the fee? And ours is more sophisticated than this and does more things and proprietary this and patent pending. And we lost the fight. And eventually took the core product down to 25 basis points. And with the premium product, kept it at 50 basis points, but added additional very visible value. And so I would hypothesize that a reason for the pricing being maintained is if you don't know what you're paying, and it's hard to figure out what you otherwise would have, the pricing doesn't go by the wayside. Now this is where FinTech is not the potential to take down pricing, but is taking down pricing. And how can we charge 25 basis points or 50 basis points and hope to make a fee? Well, in parts of our business, we don't have financial advisors, and at Merrill Lynch, 52% of the revenues went to the financial advisor, right? So you are substituting technology for people. Okay, I'm only going to be another minute. Because a platform for women, that is so sexist. Women don't need their own thing. This is what I said when people told me that I should found this. But it became clear to me that women don't invest as much as men do in this country, that it costs women hundreds of thousands of dollars if you're making 85 or 100K a year. For some women, $1 million plus over the course of our lives. It is real life-changing money. And while the industry has sort of blamed women for this, they're so risk averse, right? They need more financial education. They outsource it to their husbands. They're not as good at investing as men are. I mean, after all, watch CNBC, it's a bunch of men, right? So therefore, it's like a manly man thing. Plus the bull, hello, phallic symbol. I mean, right there, right? There's not a woman on the planet. You know, that bull just speaks to me. I love that bull. Not a woman says this. And is it a coincidence, one might wonder, that the industry we've been talking about, which financial advisors are 86% men, and much like the fee that didn't change, that number has never changed. The boom, boom room in the 80s, we had our Me Too movement 20, 30 years ago. It's been 86, 85, 87% Caucasian men ever since. It barely moves. And is it a surprise that an industry that's overwhelmingly populated by a certain type of person does a better job of serving a certain type of person than other types? And so the industry has really kept women, people of color, on the sidelines. And so I went from, gosh, this is a sexist thing to do, to nope, this is a feminist thing to do. And let's spend thousands of hours with women, not in the superficial way, let's hold a focus group and see what they say, but in a deep way of what it is they're looking for in investing. And let's just say it's not, you know, of all the thousands of women we've spoken to, you want to know the number of women who said their goal was to outperform the market? Guess. It was one. One. And then after she said she wanted to outperform, she said, that's what I'm supposed to say, right? What women are looking for is to reach their goals in the majority of markets, to be able to make trade-offs among their goals, to understand what their downside can be, not in terms of standard deviation, not in terms of drawdown risk, but in terms of how bad can it be and am I still on track to do what I want to do. And we were able to build this into a technology platform that we're still new, we're still small, but just a couple of months ago, just a month ago, we crossed 100 million of assets under management, which is the fastest, we believe, or as fast as any of the other digital advisors out there, faster than most of them, even while we're taking in, because we can with technology, $100, $1,000, $10,000. We had somebody last night who deposited a penny, score.
Anju, I wanted to turn we've had perspectives from both, you know, Chinese-based platforms, also U.S.-based platforms. An hour ago, I think during the lunch section, we were talking about China and the U.S. going to war. But what I'm more interested in is, you know, you have a unique perspective on the investment landscape in these two countries, specifically as it relates to FinTech and as managing director of the CreditEase FinTech fund. So I'd really like to know, you know, what are you seeing as some of the advantages and disadvantages of each market that you kind of oversee? And in particular, do you see some of your investments really paying off in terms of these platforms to really address more of the impact from a inclusion, access to capital perspective, and then transparency as well?
Sure, thank you. Just to expand on what he mentioned, so I work with CreditEase, which is a leading fintech company from China. If you guys were at the morning 8 a.m. session, Ning Tang, who's the CEO and founder, he was one of the speakers. And we have a large wealth and asset management business through which we deploy several $1 billion every year into global alternative asset classes such as VCPE funds, real estate funds. We have a credit fund, and we have a FinTech fund, which is, the FinTech fund is a $1 billion fund through which we invest directly in FinTech companies and mostly in the US. So I live in the Bay Area and we've invested in about 25 companies so far. Ellevest is one of them. So glad to be part of Sallie's company. And I have to say, when I first started talking to Sallie, I didn't get the sexist angle or the feminist angle. And I had to meet them like 3 times. And once I got it, I really got it, because they really build great portfolios. So glad to be part of that as well. So when I look at the FinTech landscape globally, and before that I lived in Singapore for 20 years, where Jonathan and I worked together at Citibank also a long time ago. I find that when it comes to B2C FinTech, which is consumer-facing FinTech, China is now way ahead of everywhere else in the world. And a lot of it is linked to leapfrogging to smartphones, not being burdened by the legacy platforms and the traditional systems, and also partly because the big banks in China never really cared about offering any consumer products. So it was like a blank sheet of paper. Foreign banks had too many restrictions, and local banks didn't really care. And when the FinTech companies came in, there was a huge opportunity. They leveraged technology and built out great solutions. CreditEase also has, for example, we have a subsidiary called Yurindai, which is listed on NYSE, and that was the first mobile lending app in the world. Similar to what Jonathan described, it uses a lot of alternate data, uses machine learning for credit risk management, fraud risk management. Fraud is very high in China and in most other emerging markets, and all the lending is done using the smartphone app. Now there are other players as well. Some of the US companies have already also started doing it, but that was the first one. Even in terms of payments, China is so far ahead in terms of mobile payments. And a lot of it, because of scale and use of technology, translates into cheaper services for the consumers, right? I mean, in Alibaba's money market fund, which is now the largest fund in the world at over $200 billion, people can start with 1 RMB. And there is no fee, hidden fee or otherwise, right? And it's instant real-time transfers. Or even e-commerce in China, because of the size and scale and usage of mobile commerce, merchants pay only 0.6% discount rate compared to, say, 3 to 5% in the US. So technology does help in reducing the cost to the consumer. And that's a lot of B2C where we feel that China's leading the world, and now we're starting to see that in a lot of other markets. But when it comes to B2B FinTech, I think US is still way ahead. If you look at the FinTech investments that were made last year by the VC industry, close to, I think, $27 or $30 billion, over 60% of those investments last year were in B2B FinTech. Even in Europe, 1/3 were in B2B, which is very different from what we used to see 4 or 5 years ago, when 75% of the investments, even in the US, used to go in lending or payments in consumer-facing platforms. So it's not so much of, I mean, 5 years ago, US was a lot about competition between FinTech and banks. It's shifted a lot to collaboration and building solutions for the banks. And I think right now, both FinTech and banks are worried about big tech rather than worrying about each other. So that's another new variable in the US, where we're seeing big companies like Amazon or Square getting into consumer-facing stuff, or like WhatsApp has launched payments in India, or Google has launched person-to-person payments in India using Google Pay. So the landscape is changing quite a bit. But when it comes to B2B FinTech, we still find that US is so much more ahead, and there are so many investment opportunities. So we've been focusing a lot on that. So our portfolio, I would say, is like about 1/3 consumer-facing companies like Ellevest, and 2/3 are B2B.
I'd be interesting, given your insights, and then Jonathan, you had mentioned a little bit on the regulation side. PBOC has become very active in the regulatory space as it pertains to FinTech. Do you see any potential problems in terms of China continuing to kind of be one of the standouts in the FinTech investment space? I mean, is it going to be a reduced amount of investment given the fact that the PBOC is very active now?
Well, I would say that in China, the FinTech sector developed very much with implicit regulatory support. It wasn't explicitly stated, but it was implied, and the companies were able to grow to a certain size before the regulations came in, which is great because proportionate regulation makes a lot of sense. It's great for financial stability and consumer protection. And it's also good to have clarity. We've seen that the markets where there is clarity on regulations always results in better valuation or better end outcome for the fintech companies. I mean, UK is very supportive of fintech companies. Singapore is very supportive. India has a different approach from China, top down, but again, very supportive, centrally designed and planned. Yeah, so I think proportionate regulation makes a lot of sense. You can't say same regulations that apply to banks should apply to fintech companies. It has to be in line with the size of the company and the kind of risk that they pose to the economy.
Jonathan, I don't know if you have any other insights.
Well, I think that the march of using technology to facilitate finance in China is irreversible. And I think that the consolidation, for example, in the P2P sector is probably something that was inevitable. I think that as a national strategy, China is focused on being a technology leader on many, many dimensions in its economy, and of course of AI in particular within all of that. So I think you'll find there's still strong support and strong openness to innovations. I will say, having said all of that the innovation we see in China tends to be concentrated, and it tends to be driven by very large corporates, much more than it is driven bottom up, as it is in a market like this or in Europe from small startups. So it's I think probably a different paradigm has emerged, and I don't see regulation being a constraint on innovation in particular. But I think you just have to understand China's a very different landscape, and when you've got 3 or 4 big companies overwhelmingly driving the innovation, it's a very different set of dynamics than when you've got thousands of startups vying for viability against each other.
Tom, speaking of regulation, as the former U.S. comptroller of the currency, you spent a lot of time focused on the role of fintechs and the financial services ecosystem. In particular, you came out with the responsible innovation framework, but then you also came out with the special purpose national bank charter draft. By the way, it's not actually live yet. What was the thought process behind this? Was there a global competitiveness kind of element to this, seeing as how China could potentially leapfrog us at some point? And as you were going through the kind of the formation of this special purpose national bank charter, how did you keep in mind the need for to address inclusion and how fintechs could respond to inclusion and access that banks have to under CRA, for instance?
Sure. I really came at it from a prudential and a public policy standpoint. From a prudential standpoint, whether you're a bank or a fintech, technology is a major strategic risk. How you manage that risk, particularly with banks in terms of new products or systems changes, you really need to be thinking about it. So that was the entry point for the OCC, the agency I headed. From a public policy standpoint, part of the mandate of the OCC is not only safety and soundness, but fair treatment of customers of banks. So it was very important that whatever we did from a public policy or regulatory standpoint, that we took into account fair treatment of customers, which really translates into making sure that there was a benefit, that either better products were being delivered to people at lower cost, and more people that otherwise might have been unbanked were part of that process. The issue that we were confronting with the special purpose national bank charter really is trying to smooth out what is a very complex and fragmented banking system in the United States. If you're a non-bank fintech firm, you really have to go through the maze of 50 different states, cram yourself, licensing statutes, cram yourself into a 19th century definition of that service, whether it's a money transmitter or a loan broker or whatever. You have to cram yourself into that definition and do it 50 times. The advantage of the national bank system, which goes back to the Civil War, is that it is national. That means you have one set of rules and one supervisor. So then the thinking at the agency was, well, how do we adapt this charter for something that isn't really a traditional bank. And that's really what the draft paper was, how we would supervise, what we would expect from a capital standpoint, and what our expectations would be for what we called financial inclusion, which is really a hybrid of consumer protection or compliance and what would be for a bank, the Community Reinvestment Act. So that, again, tailored to the business model of the particular firm, in order to give them a platform that could operate nationally and not really waste resources and development costs in cramming themselves into again, as I said, an archaic 19th century system of regulation. Unfortunately, that resulted in some litigation. My view was that the OCC could have done this unilaterally. If one of you in the room, if your FinTech firm came in, I think we had the legal authority to give you a charter if you met what our expectations were. But again, trying to set a framework for regulation of non-bank FinTech firms, wanted to do it in a transparent fashion to lay out what the expectations were in paper, and then to allow people to come in and have informal talks about whether that model would work for them from a structural standpoint, as well as any other issue.
So clearly, a lot of activity in this space, a number of platforms out there that are, showing impact and actually, at the end of the day, I think driving down the cost for the end user through digitized services and no more physical paperwork. And I think that's something that the Milken Institute is certainly looking to continue to focus on as we move forward with our FinTech program, is more on the impact side rather than talking about simply the potential of these technologies or what is FinTech, right? Which is why I'd like to announce today that the FinTech program is forming a U.S. FinTech Advisory Committee. Tom Curry here will be the chairman on the committee. And I believe Melissa Koide is somewhere in this room, if not straight back there. She will be vice chair, as a former Treasury official with now CEO of FinReg Labs. So very happy to have both of you on board and really looking to drive the discussion further as we continue. So very excited to announce that, and looking forward to engaging with you and Melissa going forward. Thank you.
Thank you.
Let's get back to the second thing that I want to focus on in particular, and that is viability of the FinTech platform, right? Whether it be Ping On, whether it be Ellevest, whether it be LendUp. As you guys are looking to connect more and more with individuals to target, by definitions today, very at-risk individuals. How are you able to kind of maintain that outreach, but at the same time making sure that you still have a platform at the end of the day, and you don't end up overextending yourself? Anyone in particular want to focus on that? And I think, and sorry, Sallie, but from your perspective, when you talk about all these, the influx of platforms, moving into the kind of digital wealth management space, whether it be just the digital startups, the Betterment and Wealthfront, or the Vanguards and the Schwabs. How are you, at the end of the day, especially focusing on one specific demographic, able to kind of challenge them?
Well, so a couple things. First of all, we've talked about the positive impact of price to the consumer. What we haven't talked about is being able to provide a superior product. That through the use of technology, we can provide a highly tailored investment portfolio, taking into account the fact that a woman should live till X age. We're the only gender-aware investing algorithm that we're aware of, but it's super important if you're going to outlive the man in your life, as many women will. 80% of women die single. It's important to take into account the fact that her salary peaks sooner than men's, unfortunately by about a decade, that she takes more career breaks than men do. So using technology, we can highly customize what we view her salary trajectory to be. She then tells us the goal she wants to achieve. We're able to calculate how much of a house she can afford, how much money she's going to need in retirement, how much it's going to cost to have a baby, et cetera, et cetera, et cetera. Enable her to make trade-offs, and then provide an investment portfolio, not the old-fashioned way, which was, well, you know, it should be about 60-40. But here's your investment portfolio tailored to your home goal, with a target of getting you there in 70% of markets or better. And here's your investment portfolio targeted to your retirement, taking into account your outside assets, how they're allocated, et cetera, so that we have highly customized, essentially individualized target date funds by goal, okay? Now, the often we do hear, and I heard a little bit of in your question, well, if you're only, you know, if you're targeting this niche, you know, how can you survive? Well, it's 51% of the population, and 51% of the population who really the industry implicitly hasn't been speaking to. You know, by speaking to everybody, you're speaking to nobody. And so we have really targeted the professional woman, not by age, but by sort of her bent in life, right? She's made her own money. She's confident in all areas of her life. You know, investing is one place where she just hasn't had that level of confidence because she felt like the industry hasn't been speaking her language. And so we're the ones to come along and begin to speak the language. Now, something else very interesting is going on here. Because you'll say, well, can't other folks do that? Yes. The millennials are looking for authenticity. And so what they really don't like is you go girl from a company that's all men. And when I actually took a look a couple of weeks ago at 7 digital investment platforms who you would think of as our competition, you know how many women were on the boards of all 7 of them? 0. 0. And so what they do is they look at us and say, your chief investment officer is a woman, you're a woman, you have tons of experience, your employee base is 40% people of color, you reflect me. And those are the kind of people we want to do business with. So I think it's a superior product, a lower price, talking exactly to that person, not to everybody, and authenticity in what you do, we're believing and seeing as a winning combination.
Jonathan, and you know, you got 400 million people that are utilizing your platform. As you continue to kind of expand and connect with even millions of more users, you know, how are you making sure that at the end of the day, a diversified platform such as yours is able to kind of minimize the risk?
Well, I think diversity is usually a good thing. So we're a financial conglomerate in one sense. We're extremely focused on customers and making sure we're bringing a very wide range of services to build relationships across our platform on the other. I just wanted to come back to this question about, you know, how do you make sure that if you're using technology to serve a very broad range of segments, how do you make sure it's viable, and how do you make sure you manage the risks? The way I think of this is that the industry structure is sort of, you can start to see a new paradigm emerging. Instead of sort of vertically integrated institutions that basically, you know, manufacture and distribute, at the consumer level, I mean, Sallie just gave a great example of a focused proposition that's essentially built around a segment of consumers. Just happens to be half the population in this particular case. But, you know, we can see other examples of financial services being embedded into the e-commerce stream in the way that, you know, when you buy travel insurance, when you book online for an airline ticket, that product is now adjacent, it's priced attractively, it's just one tick of a box to buy it, as opposed to having to go and have to think about purchasing a product standalone. Many analogies in the payment space as well for e-retailers and so forth. The whole sort of infomediary side of the kind of Credit Karma model is another model that's emerged. I think there's a whole range of these models that are challenging the traditional generic distribution of legacy financial institutions. At the platform level, I think this whole idea, and building on Anju's point about the investment opportunities in B2B, what's really happening is you're seeing what I call the platformization of finance, and pretty much every service that even today is still licensed software running on-premise computers owned by a financial institution, maybe supported by outsourced vendors somewhere, doesn't really matter. That model is just going to go away. It just doesn't make any sense. And every single part of it's going to get replaced by world-class platforms that are multi-tenant cloud-based. And then you get to the regulatory level, and so you say, well, what is the role of these licenses? Well, some of those licenses are just going to be APIs that are just utilities, and they're going to meet their regulatory requirements to make sure the depositor funds or the insurance obligations or whatever are safe and secure, and that's all they're going to do. Some people that own those regulatory licenses will do the other two things as well, but I think you'll see a reformation of the industry around these three things. And what that's going to do is, one, mean that the front layer, what all of us are doing for our customers is just so much more focused on needs, is so much more efficiently priced and delivered. It's going to mean that the platform level massively reduces the barriers to entry, and these two levels actually can be completely decoupled from regulatory privilege, and therefore can exist independently of the regulatory system. There's some regulatory obligations that will go with delivering a regulated service, of course, KYC obligations or just basic integrity of systems and so forth. But I think this is a fundamentally more efficient way to structure the way we deliver financial services. And I think you can see it emerging in many places in the world today. So that's one way I would answer the question.
Sasha, according to FICO, you shouldn't even be involved in this space. So how is it that you're able to continue to connect with, with a number of these, quote unquote subprime individuals, and at the same time, maintain the kind of the viability of your platform?
That's a good intro. So let's see. So it's still a $350 billion market. It's still 56% of our country that are excluded out of the traditional banking system. I think the average checking account holder has a 620 credit score. An average person getting bank credit has a 720 credit score. So there's a mismatch. There's a lot of our customers that are our country that are sort of locked out of the system. But so when we think about delivering products in the market, we kind of think about them in three kind of main axes. The first is it has to be profitable. And when you have the most stable asset class, if you can price for risk appropriately, you get outsized ROA returns compared to traditional credit cards where maybe you make a 50 basis points, 100, 200 basis points ROA. So you have to have healthy financial returns. And the second is you want to build something that customers love. So I think that we're the sort of first socially responsible credit card company. We're definitely the first venture-backed credit card company to launch in the United States. And within a year, we're already the cardholder's choice on Credit Karma within your perfect customer rating, about 4.7 to 4.8 out of 5. When you look at other subprime credit card issuers in the space, it's about a 2, 2.3, 2.4. So you see this good financial returns with customer loyalty. Two, customers rate and measure this, or sort of rate your product highly compared to the others. So just a transparent, safe, has all these great, fun technological benefits. And the third is you measure the impact that you're having, because outside of that, you want to make sure that you're having a positive impact on this country or on the communities. And so we measure this across three different axes. The first is how much money are we saving customers? And to date, we've saved customers about $200 million compared to their next best alternative. You want to make sure that you're helping improve financial literacy. We've given over 2 million credit education courses in financial literacy across savings, budgeting, how interest rates work, how credit scores work. And then you want to improve people's credit scores. And we've increased customer almost 500,000 credit score points net across the platform, which is about a 50% higher likelihood than anybody else in the space. And why this is important is the average person with a subprime credit score in the United States will pay $250,000 more over the course of their life. That's totally unfair, and that's totally solvable with technology and better products. So
we have three platforms up, up here, but Anju, you recently conducted a study with the IFC where you looked at, I believe you ranked 100 FinTech platforms based on, financial inclusion. What were some of the common characteristics or traits of these platforms? And then, how are they able to, at the end of the day, kind of expand access and to credit and create greater inclusion, but at the same time making sure, again, that they don't end up being, end up messing around with their platform at the end of the day?
So this study is called Financial Inclusion in the Digital Age, and we published it last year jointly with IFC and with Stanford Business School. And the background to the study is that I was at Stanford a couple of years ago as a Fulbright Fellow and visiting scholar, and my research topic was on FinTech and financial inclusion. And I was talking to some of the professors there, and they said, oh, financial inclusion, that's an emerging markets problem. I focus only on the US, and I don't know much about it. And something about the tone just got me a little bit irritated, and I said, I have to start digging into this problem. One, is it only an emerging markets problem? And anyway, fast forward 18 months. We did a lot of work on that, found a lot of studies about the gaps in this space. And the statistic that stood out a lot for me was, we all hear about the World Bank report, which says 38% of the adults globally are unbanked, meaning they have no access to financial services. What we don't hear often is that another 57% have a basic bank account, may have something more, but don't have access to the full range of financial services, which includes access to credit, ability to save, access to insurance products, and all their financial needs. So you look at that and you say, okay, that means only 5% of the people have full access, and that kind of fits in very well. I spent 25 years in banking in Asia Pacific mostly, and the foreign banks that I worked with typically targeted the top 5% of the population, sometimes even less. And that 57% of the underserved population, where it's underserved by the banks for a variety of reasons. It could be lack of access, lack of distribution, they're not close to a branch, or the product design that Sallie referred to. The products are just not designed for the segments that don't bring so much profit for the bank. And then pricing could be another factor, right? So if you look at all of those, what are fintechs solving for? They're solving for all of those things. They're using technology to provide access to people. They're using technology to build products, whether it's an insurance product that's manufactured for very niche segments, or whether it's a micro savings product which is manufactured for consumers so that they can save as part of their daily lives, or it's part of the lending ecosystem, right? Like there are companies which are now supporting the companies like Sasha's through a credit score, or through providing access to alternate data sources in a structured manner. So all of it put together. So these companies are actually solving for specific problems to help the underserved people, which is 57% of the population. And I think in that segment, it is certainly possible to use technology and build solutions at scale which are profitable. So what we then did was we showcased 100 companies which are very mission driven, but at the same time focused on profitability and viability. And what are they solving for? What is the central friction, or what is the gap in their needs that is not being solved for by traditional banks? And therefore, how are they building? So these are all consumer facing companies. And we've given examples of how they've done things in not just Africa or Latin America or South Asia, but also very much in US or Europe to deal with those problems.
Speaking of problems, as a former comptroller of the currency, you dealt with the tension between, how do we address this innovation, at the same time, how do we maintain certain protections, and then at the same time, how do we maintain a level playing field between those who are already within the banking system and potentially new entrants. So talk about that, level of, I guess, maybe it wasn't a difficulty, but talk about that level of difficulty. And, how do you, as other regulators, and I'm sure there are a number of individuals from the IFC, Milken Institute Capital Markets program that are here, as they go back to their countries and into their regulatory roles, what advice would you give them as they, take over the front lines basically in dealing with innovation?
I think we started out with the last question is how do you have a level playing field? I think it's bringing a fintech firm that's doing a product or a service that a bank does have comparable rules. I wouldn't say the same rules, but that would introduce a potential level playing field. And those rules apply. One of the things that I think we observed early on particularly with consumer lending firms, was that initially they thought the rules didn't apply. They do. Well, they're creditors. Under the law, you're a creditor. It doesn't matter if you're a bank or a non-bank. So I think that's important from a consumer protection standpoint. There are some basic expectations that banks are held to. And again, there's also, again, in the credit example, truth in lending in the U.S. and all these other laws apply to you as a creditor, not because you're a bank or a non-bank. So there is a similarity between traditional banks and FinTech firms, but it's a matter of degree or proportionality. So how do you, tailor your regulatory requirements to the institution? And our solution was, we'll bring them into the fold as a national bank. In terms of consumer protection and financial inclusion, I think it's really essential to the future development of technologies and FinTech firms. I think going forward, if there are abuses, that will create a political, legislative reaction, which actually I think will be counterproductive. So a level of consistency in what your expectations are, particularly in the consumer protection area, and also if there's if you can document it and emphasize the fact that underbanked or unbanked people are being brought into the mainstream, that's the approach, and you can do it under the umbrella, at least in the U.S., of a special purpose national bank.
One last thing for you, Tom, and not, maybe to put you on the spot here, but the current comptroller, Otting, has said he's going to give a position on special purpose national bank charters for fintechs within the next 60 to 90 days. As he kind of gets up to speed on this, what would you like to obviously see that position be?
Well, I hope he does make a decision. I think one of the problems in the U.S. is the lack of certainty as to what the regulatory structure can be or should be. One of my reasons for putting together the concept, the white paper, and the chartering manual for special purpose national banks was to actually create that certainty. And again, I hope he follows that outline that we put together. It's consistent with sound supervision and regulatory approach. A lot of work's gone into it, and if you want to flip the switch, I think it's ready to go.
We have a couple more minutes here, 5 more minutes, thank you. Real quick question for each of you. A lot of the fintechs that have come out over the past couple of years have, said that their platform is going to do this and that and have high expectations. In your view, as you look, whether it be the Chinese market, U.S. market, or elsewhere, what's oversold at this point? I mean, what's not? What was expected to meet a lot of expectations and then just fell short at the end of the day? Anyone want to try and take a bite of that?
Bitcoin and blockchain.
Bitcoin and blockchain.
Yeah, I'd say that cryptos are massively overbought. And we can get into a long discussion, which we don't want to have here. But I think I think of the cryptos as a subset of applications of blockchain, which has a much broader potential applicability, which in turn is a subset of the broader topic of asset tokenization. And I think that is a massive transformative vector that we will see much, much more of and will be extremely important.
Real quick, is Ping On deploying any blockchain DLT-like?
Yeah, we have a platform that we created which allows interbank transfers between 400 small to medium-sized banks in China. When I say small to medium-sized, the largest of them is 1.5 trillion RMB in balance sheets. So it's about $250 billion, so it's not that small. That platform in a year and a half has traded about $2 trillion in US dollar terms in volume. So it's probably the largest blockchain-based trading platform in the world. We've just won a contract with the HKMA, actually, the Monetary Authority of Hong Kong, to work with them to build a blockchain-based trade finance platform with, I think it's 11 banks in Hong Kong, to support 11 banks in Hong Kong, as 2 examples.
Yeah.
So I am wildly bullish on the impact of FinTech. I think everything takes longer than we think it's going to. I remember being at this conference 2 years ago in what was the equivalent of this panel, and someone up on this panel said, if your job today is taking this column of numbers and cutting it and pasting it over here and adding this column of numbers and dividing it by that, find a new job because your job is gone. There's still a lot of people doing that today. So it's going to take longer than we expected, but that job is gone. What will remain will be the relationship jobs, that you can't replace, at least yet, with a computer. But everything else, all the cutting and pasting, even my old job, the writing of research reports, this is going to be taken over by FinTech. It's going to massively reduce cost for the end consumer. I think we'll deliver a better experience in many cases. It's going to go slower than we think until it goes faster than we think. If there was actually just a FinTech that could warm up this room, I would be so happy.
I see you're almost building a fire over here. Yeah.
I'm about to hug you just for warmth. In this Me Too era, that would not fly.
Sasha, any insight from you?
I think we have an opportunity from my lens in FinTech, at least in the United States, to do three things. Transform FICO from the score to a component or a part of a score. I think that we will have an opportunity to democratize financial services and allow more of a level playing field where credit turns from sort of a trap into an opportunity. And I think we're going to see a lot more partnerships with greater banks and financial institutions that want to play with both the most forward-thinking, technologically advanced, customer-friendly products in market, or segments that they have ignored that technology will allow us to talk to in a meaningful and personalized way.
So thank you all for coming today. For those who want to know and understand more about the Milken Institute FinTech program, we do have about 100 copies of the program and a description that should be by the door, I think. Thank you, guys. Thank you all very much. Please give a round of applause.